I want to talk about one of the worst mistakes you can make as an investor, and that is being on tilt. So that's an expression that comes actually from the online poker world, as in you actually know what to do, you know the right moves, you know the probabilities, you know what's actually correct, but because it's both a game of skill and of luck, sometimes even though the probabilities are in your favor, you might still end up losing temporarily. And temporarily can be several weeks potentially. So the problem with that is that even though you're doing the right thing, you do not necessarily get the right feedback from the market. And that then leads to getting very frustrated, to be on tilt. So you're getting so frustrated that you want to basically throw away everything, that you want to hammer on the keyboard. And the problem is that with that comes usually increased risk tolerance. So in online poker, what happens is people simply start playing games that they can't really afford. They tend to take on risks they can't afford. They bet with sizes that aren't justifiable relative to the bankroll. And in crypto, this can happen the exact same way, right? Let's say you're betting 30% of your entire crypto portfolio on a relatively risky bet on an altcoin that you think will go up. But then in the end, maybe the entire crypto market is going down. And so your levered altcoin goes down even more. And in the end, you end up losing the majority of that 30%, right? Maybe you lose 80, 90% of that bet. You're down with your portfolio by 25%. Then you repeat the same thing. You think again, you've got a good bet. You're down again another 25%. Your entire portfolio is down 50%. What then happens is that a lot of people take these past portfolio values. So let's say you move from 100K down to 50K. They take this past portfolio value and they want to make those losses back. They're chasing the losses. And that is pretty close to being on tilt in poker. You start taking potentially risks that are even higher to what you have taken before. You might take your entire remaining portfolio, the entire 50K that you've got left, and put this all on a single bet. And then, if you're not lucky, you're completely getting crushed. That's the elevated risk of ruin. This is how you call this in statistics, right? When you ran a random experiment and you've got quite some volatility in this, how risky is it that you actually hit zero? And so if you've been around for a while, you know this already intuitively, right? When you go down by 50%, you actually need to double. So you need to go up by 100% just to be back to your original level. If you go down by 70%, you have to more than triple your portfolio to be back at the original level. So usually what happens is that when you go down, you actually take a longer time to recover. So you go down, say maybe for a year, you might need another 2 years to recover just to be again at your initial. What one should actually do when you're not successful with a trade or two and you're down, what you actually should be doing is instead of increasing your risk exposure and tracing those losses, you should actually reduce your risk exposure and accept that things might take longer until you recover. Because very often there's a reason why you're down that much, right? When you're down, say, by 50%, then you've either not been very good with general market timing, or alternatively, you've been very poor with risk management. Because let's say you're a really good trader, right? Let's say 70% of your trades win and 30% don't. But let's say you bet too much of your portfolio and say in the winning trades, in the 70% winning trades, you're doubling, but in the 30% losing trades, you're going down by 80%. It's very much possible that you still have two losing trades after one another. And going down by 80% twice is pretty much an entire destruction of capital. So you can have a good winning rate, but that can completely destroy you still if you don't manage your risk properly. So making bets with positive expected return is something you need to get fundamentally right, but it's not enough. You also need to manage your risk properly. And getting on tilt is really problematic because it is the final blow to something that might have just been bad luck. You might be actually skilled. You might actually on average make the right calls. But the problem is that maybe you didn't have proper risk management and then you get so frustrated, you get so overinvested that in the end you go even deeper down that wrong path. The best way to avoid this is to have fixed rules and to only trade when you've got a cool head, right? If you feel like taking on more risk than is justified, then just sleep for a night or two, right? Restart with a fresh mind. If you're in general getting caught up by the ups and downs of the market, then maybe consider diversifying across asset classes, right? Maybe you are in general overexposed to what you can stomach. You want to find a balance. On the one hand, you want to be able to digest the ups and downs. You don't want to overexpose yourself. But on the other hand, you also don't want to underexpose yourself in the way that whatever you expect to return, let's say that's 30% alpha per annum because you do a lot of research, you make 30% on top of just buying and holding Bitcoin every year. Make sure that whatever you're investing is actually worth it to you, right? If you only have $100 invested, then those 30% alpha won't do much for you. But on the other hand, you should be okay with the volatility. When you invest, say, $20,000, you should be okay when it goes down temporarily to, say, $15,000. If you're not okay with that, then you have to also own some stock. Then you also have to own maybe some gold, maybe some long-term government bonds, right? Then you have to diversify more, potentially reduce your expected return overall with the entire portfolio. But at least then you're not getting on tilt. At least then you're not taking on risks that you can't digest, that then in the end will completely let you quit the game, right? The main objective in this investing game is to simply just stay alive for as long as possible. And if you don't die in the process, if you simply just learn and learn and learn, then over the time you should be able to beat the market, right? The people that are in the market for the longest tend to also be the ones that are most skilled. And the people that are more skilled tend to make most money. Of course, they're still losing trades every now and then, right? But again, it's a game of both skill and luck. If you're looking to find content on how to elevate your skills further, on how to get into blockchain analytics, if you also want to talk directly with me one-on-one in Telegram, then feel free to join our premium membership. The link is down below. It's thebitcoinstrader.com. Feel free to check it out. There's also a 1-week money-back guarantee. So in case you don't feel like you get adequate value, just message me in the first week and I will send the money back. See you on premium and see you in the next video as well. Cheers.